Okay, very good morning everyone. This is the brief for the 1st of June 2018. Today we're going to be looking at some of the effects that we've seen in sort of the European assets and the US assets following a week of instability in Europe due to a lot of political instability in Spain and Italy and some issues facing Deutsche Bank as well. So some follow through into sort of Germany as well as France, with Macron trying to push forward his economic reform. So a lot of instability in the European area this week. I'm going to see what effect that's had on the markets, then look ahead to see, check out the data calendar. We have non-farm payrolls today. So in terms of market conditions, it might be quite choppy coming into the beginning of the day, the European session, but things should pick up in the afternoon once we get the data out of the way, and we'll be reviewing what numbers we're expecting and potential price action before Sam jumps on to look at the technicals. So before we look at the headlines, I'd like to have a look at the charts for a moment here. So starting off with the euro-dollar as your FX pair. What we had seen is this week, obviously a shorter week with bank holiday Monday, so the week really was starting here for the European traders, the British traders, on the 29th. So what we saw here is on Monday, so on the weekend, what we saw was the president of Spain reject the proposal for the finance minister for Italy, which then sort of put shockwaves as we saw this populist movement in Italy start to gather momentum, and that then rocked the euro currency, which is already on a downwards trajectory, but that sort of accelerated and also filtered through into sort of your European equity markets. So if I just pull up the respective chart for your FTSE MIB here, over here, you can see that this week really saw quite a heavy down week. And if we extend sort of your charts out, where we found support was loosely around the price point where the equity market fell to in February following the inflation fears, which was triggered by the United States. But this renewed political uncertainty in Europe sort of rocking what was a strengthening market all the way down to test these lows and then finding some support. And in recent trade, we have found some support, and we are trending higher. So there is a bit of positivity in this market, and you can see this reflected in the European currency as well. So if we broaden time horizon, this market has been selling off quite aggressively now, almost since the beginning of 2018. So within Q1 of 2018, breaking out of this trend, and a downwards trend really started to catch some momentum. Going on the longer time frame, looking at the chart technically, we took out the 200-day moving average, and that sort of allowed another little push to the downside. Finding some support here, a bit of consolidation, another little push lower. What we have seen, however, recently is we saw German inflation numbers as well as European area inflation numbers come in at a beat. So your headline inflation numbers were quite healthy. Your core inflation number is still a bit lackluster at about 1.1%, but still better than expected. This has allowed a bit of reversal, and as people stop panicking as much about the Italian situation and the Spanish situation, which we'll touch upon in just a moment, we are seeing some renewed optimism in the euro currency, but I think largely triggered by the positive inflation numbers that we saw coming out of Germany as well as the European area as a whole, allowing a bit of a reversal and an opportunity for some profit taking. But I'm not reading too much into this bounce at the moment. Yes, quite aggressive here, but really, if you look at the aggressiveness of the move on Monday and Tuesday, to expect some profit taking is understandable, but we're still beneath the price point we were trading on that Monday morning, which is understandable because the Italian situation hasn't gone away. Conte is being sworn in as Prime Minister today, with Di Maio and Salvini being elected as a Deputy Prime Minister. These guys are still Eurosceptics. So they may have sort of pushed away the problem slightly, given the fact that the finance minister, sorry, who is it? Savona is not going to be the finance minister. So being a Eurosceptic, wanting to get rid of the single currency, him not being in a position now as the finance minister has pushed the problem slightly further down the line. But then what has he been accepted as? Well, he's been accepted as the head of European affairs. So a Eurosceptic having to deal with other European countries, this could spell disaster going forward. But at least for now, the markets seem to have just settled. But I don't feel that Italian risk is completely done at the moment. Eurosceptic parties are still coming into power. It's going to be interesting to see how this develops over the near term. So I think it's understandable that the market is remaining underneath this Monday low as the risk is still there. Also, other negative factors affecting the euro currency is what's happening in Spain. The vote of no confidence today, where we'll see, where everyone, including Spanish senior officials, are expecting Rajoy to be voted out with a vote of no confidence. So again, that's more political instability, but who's coming in to replace him? Well, largely sort of a mix of people taking over, with European politics as volatile as it is. With him stepping down, this is what the likely breakdown of the seats are going to be. So the current breakdown here, you can see the People's Party, which is where Rajoy heads, makes up the largest majority. Now, if there was a vote of no confidence and Rajoy was pushed out, it's mainly being led by the Socialist Party, which can be seen here in pink, and Podemos as well here. These are your two largest parties who are leading this vote of no confidence. And what we've seen in the past couple of days is party after party has come in to support this vote of no confidence. So everyone is pretty much, and the market as well. When I say everyone, it's not so much the Spanish officials, but the market as a whole is comfortable that this vote of no confidence is coming. It's just about the breakdown of how it's gonna happen. So your two major parties here, the Socialists and the Podemos, are going to be leading this, and then you could see a couple other smaller parties making up the seats required for the majority. So we also have the Catalan Republic left here as well, which then could once again see this resurgence of this divide between Catalan and the rest of Spain as well. So again, problems being pushed out to the future. We are seeing the Socialist Party agree to the budgets which were suggested, whilst I think the Podemos Party has said that they're not going to abide to the budgets which were proposed. So we can see that, yes, Rajoy is leaving, that he's not being replaced by a populist party, so definitely not as negative for the euro currency, but still political instability is coming, is forthcoming, and I guess that's something we need to take into consideration when looking at this euro. So I wouldn't read too much into this recent rally we've seen in the euro. The risks are still very much there. The equity market, if we just look at, let's look at the DAX, sort of your benchmark here, also being rocked with this recent instability seen in Europe. So again, we were on a good trajectory higher coming into sort of this week, and then having seen this negativity dragging down the European stock market. If I was just to flick back across so we can look at the Spanish index. The Spanish index also down around 5%. Yeah, so you can see the Spanish index here looking a lot heavier than, let's say, DAX, because of the regional implications of Rajoy stepping down. But market pundits at the moment are saying that this isn't going to be too much of a problem for the Spanish index, because these are socialist parties coming in as opposed to populists. So yes, they are still left-wing, but they're not sort of all the way to your left, which would have further negativity coming into your equity market. So at the moment, I think there's still a lot of fragility here in your European assets, including your euro. This little bounce we've seen, I think, is a bit overdone. So first, the sell-off was overdone. I think this bounce also is a little bit overdone. If we look at the fundamental drivers behind this, this is a higher inflation, meaning that Draghi would be likely to move forward their rate hike trajectory. Now, we have seen central bankers come out from Europe and say that this is an Italian problem and they're not going to be stepping in to resolve this, but it's not just an Italian problem. It's an Italian problem, a French problem, with Macron trying to push through his economic reforms and sort of targeting your train workers union and them going on strike, and the Spanish instability. I just feel like these aren't problems which are being dealt with. They're being pushed into the near future, maybe 3 to 6 months down the line, and we're halfway through 2018 at the moment. We're already on a tight schedule for the ECB to bring QE to an end, or the current QE package to an end in September, then communicate. Really, the market is expecting QE at a lesser rate to stop at no later than December. So really 6 months left for the ECB to end their QE program, and then the first hike was sort of seen to be 6 months after that. it was already a tight schedule given where we are right now, and with this instability coming, plus the Brexit, we can't sort of negate the dissatisfactory results being seen by Theresa May and her cabinet in the Brexit negotiations. So this is all building up to be quite a negative scenario, and if the ECB can then look to sort of be aggressive with the tapering of their QE program and ultimately bring it to an end in December, and then start communicating to the market that they're going to be hiking rates in the forthcoming 6 months, I think that's quite unlikely. So I think that personally, I definitely still believe that this euro should start heading down. But the risk to the upside is we've also seen further commentary from our Lord and Savior Donald Trump, who has decided to impose tariffs on his closest allies, including Mexico, Canada, and Europe itself. Again, building up to this negativity in Europe. And I mean, it's not so much that he's imposed the tariffs, but he's imposed tariffs on security threats, which I think is the biggest insult to his allies. So I guess this is also aiding to this euro-dollar move higher. Tariffs and trade wars will be negative for the euro and negative for the dollar. The euro was already cheap, therefore maybe it's time for the dollar to sell off a little bit on the back of these trade wars. So again, this isn't positive for Europe. This isn't positive for the United States. So I kind of feel like unless a resolution can be brought about, how can the ECB look to be tightening, and therefore does the euro deserve to continue to rally? Probably not. So getting caught up in the short-term volatility, I guess don't let it distract you from the overriding picture, which is very much negative for Europe, even though it was extremely positive coming into the beginning of this year. So following on from the comments about tariff and trade, let's have a look at the US equity market. Been a very tricky one to trade here. So what have we been seeing recently? So quite a bit of a recovery after, so we had this February sell-off, etc., etc., and then we were largely range bound over here. As at the beginning of May, we sort of started to see quite a bit of a rally in stocks. Then we were trapped in a range, and breaking out of this range over here early on in the week following this Italian crisis, Italian political crisis, driving us out of this range, coming to test some key sort of support levels and ultimately bouncing. So I guess when we broke out of this range, there was renewed optimism that we're going to see volatility and we'll have a direction in this market and subsequent markets such as gold, yen and T-notes as we have a risk play. But the sell-off was short-lived. We've now fallen back into the range after sort of closing below a couple times and again making it very, very difficult. But in terms of technical play, it hasn't been bad. There's been a few sort of longer term opportunities. We came down to test the bottom of this range, maybe. But I guess at the moment, Sam's going to be on the mic shortly to discuss this further. But really, largely range bound. You'd need to be taking much smaller trades on a smaller time frame. But I guess when you're trapped in a range like this, the market can be quite difficult. So as with risk assets, sort of being a global benchmark, being your S&P, largely range bound. Let's have a quick flick through your dollar yen as well. Dollar yen, even gold. I think gold is quite a surprising market. Really unresponsive at the moment to geopolitical risk. Thinking that the United States has imposed tariffs on some of the largest economies in the world. Gold really unresponsive and really wicky around here. Really not a friendly market to be involved with, and that's similar with sort of your dollar yen as well. Really not seeing meaningful safe haven flows. So again, at the beginning of the week with the Italian crisis, we did. So I guess the reason I'm saying this, I feel that the markets are once again becoming quite complacent. There's not really much positivity in the market for us to justify, well, to break back into a range and be positive. I guess the most recent developments in terms of the equity market has been the fact that deregulation in the financial services sector, but then we should be seeing some meaningful outperformance in the Dow Jones, which we're not. So I guess the best way to explain this is that markets are still really looking towards inflation and the non-farm payrolls number. Given that we had a shortened week, we had the Tuesday and Wednesday heightened degree of volatility. Then we've got Thursday and Friday. Thursday being the day before non-farm payrolls, which is obviously very likely to provide a high degree of volatility, just leaving the market a little bit uncertain as to which way it wants to go. So I guess we're going to see continued choppy price action in the morning session before we start to go on to the data set. So again, I'd say with the US equity market, just play it safe. Just play it safe. I wouldn't be really looking to touch this unless we go into until we get the data required. So just before I flick on to the data calendar, I want to have a quick look at oil as well, which, you know, brief after brief, I tell you I'm bearish, but finally, the bears are with me. So yesterday we saw the headline number, a drawdown of 3 million when we had an expectation of a drawdown of 1 million from the APIs last night. We saw a bit of upside, but then we saw US output production increase by just over 0.48%. So this gave a good selling opportunity. So I guess with the new traders, be careful, always trying to convince people not to be too aggressive with this market, because ultimately, I guess on that report itself, a drawdown of 3 million is not very meaningful, with US output production once again ramping up nearly 0.5%. I guess for me that was a bearish report, while some people traded the headline, so it can get very choppy, but ultimately you know, we did close lower, and we are seeing some pressure come through the oil market at the moment. This range, once again, finding sort of some resistance there, but really in the middle of this range, nothing very meaningful. So that pivot looks nicely lined up, but Sam will be here to discuss that. So oil very much in a sort of a downtrend at the moment, having reached these highs around the 73 mark and being rather overbought in my opinion. Okay, and let's have a quick look at T-notes. Yields obviously now below 3%, but just in terms of direction, so massive safe haven flows during the Italian and the ongoing Italian and European political crisis, but having given back quite a bit of a degree. They're still actually hanging on to our highs here, so you know, having this T-notes falling and that 3% yield being breached, we've now seen a bit of reversal, and these risks, trade wars, France, Europe and Italy, all just resulting in a bit of safe haven flow and yields just falling. At the moment, seems to be in a bit of a range as well. So bond market, I guess the real risk, or the moment where you want to be watching this bond market, would be if we start to see the bond market sell off again and those yields approach 3%. But at the moment, if we look at the December probability of a rate hike, that's fallen, was hovering around 40%, is now hovering around 30%. So I guess that market is not pricing in that fourth hike anymore. So that could also be aiding towards this dollar weakness. You know, the December rate hike was almost priced in at one point, but that's now being reversed. Okay, so having a look at the calendar ahead, we had Kaising manufacturing PMI's finals come in for May, so this was just cementing rather solid growth. So we saw the PMIs come in, the state numbers come in yesterday, which obviously showed quite a good number. So official non-manufacturing PMIs, official manufacturing PMIs coming in on the blue line. So you can see both PMIs are showing a solid uptrend. So this growth in China is still looking solid, so providing that backdrop of support for global growth still very much there. So nothing too much to worry about, but I guess in 2016 it was the same number which caused the equity market really to start to tumble. So always worth, if you ever see that on the calendar, just to check out how it was, how the numbers turned up. Okay, following on, 2 minutes now, we have market manufacturing PMIs from Europe. That is a final reading, so not going to be too market impactful, but I would be cautious if you are in any positions. And then from the UK, there's nothing really of significance until 1:30, which is going to be your main event. So again, nothing coming out this morning, so I wouldn't want anybody to be too aggressive, especially some of the newer guys. There's not much to trade, and if you do see breakouts, there'll be a bit of pre-positioning, unwinding, or some hedging, so you may see false breakouts in various markets. Don't get sucked in unless you're seeing all correlated markets move and show the same sort of trend. Coming into 1:30, non-farm payrolls, we all know how this goes now. The headline figure not being of any concern to us. Why is that? Unemployment is nice and low at 3.9%, multi-decade lows in fact. So we don't really, are not too concerned with the job creation number. We had ADP numbers this week, and the ADP numbers were just slightly below expectation, but still rather a healthy number. So I guess non-farm payrolls expectation, as always, around that 180 mark. Previously 164, so relatively healthy. I feel like a low job number, we may see a bit of dollar weakness, but nothing sustainable. But I guess if we saw a number of 150 or above, or we started to reach that 300,000 job creation again, I think this renews that fear that inflation is coming, because this is really the question, isn't it? It's not the job creation, it's about when will inflation finally pick up. And if we look at non-farm payrolls last month, if I remember correctly, unemployment came in at 3.9%, was expected at 4%. The rest of your data was rather mixed bag and actually was indicating that we're going to see a bit of dollar weakness. The only metric which was showing dollar strength was the fact that unemployment breached 4%, and I feel like traders gave a lot of emphasis to that. So even though unemployment is low and that's expected, I guess Will was on the mic and he disagreed with me on this, but my view very much was that 4% unemployment, once that got breached, we got 3.9%, so expectedly lower than expected, expectedly lower than was expected. That's what caused the dollar to remain bid, and we did see a bit of a battle initially. So I wouldn't completely ignore the jobs number. The job creation number, unless we get a breach of 300,000, I don't think will cause an impact. Unemployment rate, surprisingly fell 3.9% when it was expected at 4%. So I guess 3.8%, is the low. If we get 3.7%, I guess another bout of dollar strength. But as we're all aware, the real market mover is going to be the average hourly earnings. Looking at the year-on-year and the month-on-month, the year-on-year taking out the seasonality side of things, the expectation is for 2.7%, higher than the previous 2.6%. The upper bound is 2.9%. So we are expecting average hourly earnings year-on-year to already be higher than they were last month. Now, 2.7% is a bit of a sweet spot, because in February it was a reading of 2.7% versus the reading of 2.5%, which caused the equity market to sort of tumble 10 to 12%. So I'm not saying that if we get in line with expectation that we'll see a tumble in the market, but we are becoming more and more tolerant of higher earnings. So this wage growth story might be coming to an end, and as wage growth is picking up, if it comes in expectation or higher, then I think markets will once again reprice in this impending or the potential fourth hike in December, and that would start to see yields approach the 3% and a bit of a reversal. So it's a busy day ahead of us, and especially with the average hourly earnings. Even the month-on-month expected at 2.1%, previously 0.1%. So we're expecting an increase in this average hourly earnings. So we're expecting this inflationary pressure to start building up. So if we get a beaten expectation, I think there's everything to play for. Euro dollar, had it not rallied, would not have been in a really nice position to sell. But if we do get a nice and strong number, then euro dollar has a long way to go down as well as go up, because if you look at it in context, it's been selling off for now a couple of months. So I guess the short-term rally in euro dollar is quite favoursome for traders, because now we have room both to the downside and to the upside if we get stronger or weaker numbers. Normally I'd say look to avoid the US equity market given when we have US economic data, but more and more recently, lower average hourly earnings, you see that the market focus is very much either on bonds or equities. So some of the newer guys, I'd still very much suggest that you trade euro dollar, but keep an eye on the US equity market. Let that volatility settle down, let the trend formulate, and then I would presume that if we get sort of a miss on your month-on-month or your year-on-year, then that would result in the equity market rallying. And I'm just going to let Sam jump on in a moment, and he can just look at the technical levels for that. So after your average hourly earnings and your non-farm payrolls, 3 o'clock US time, we have ISM manufacturing for the month of May. That will be market impactful, and I guess any volatility seen post ISM manufacturing PMI will carry on to about 3:30, and then either traders have made money and they're going home, or traders have lost money and the markets get a bit choppy. But I'd say around 3:30, that's going to be your cutoff point. That's where you want to stop trading, review your trades, etc., etc. But 3:30, I feel more likely than not will be the end of the volatility and the end of this week's session. And then 6 o'clock US time, Baker Hughes rig count. Again, that'll be quite important coming in on Monday to see the direction of oil. I have no doubt that we'll see the rig counts go up once again, and that will cement this downtrend in oil. Okay guys, thank you very much. Just a quick reminder, careful this morning, a lot of opportunity this afternoon, some good numbers coming out. I'll hand you over to Sam. Have a good day. Any questions, please do let me know.
Yeah, I think that's the main thing about the morning. The afternoon should be better to be focusing on from a trading point of view. So I wouldn't want to get too involved this morning. As Saif mentioned, obviously Euro just recovering a bit here. That trend line on that week working well for the low that we saw of this week as well. I think, well, Saif obviously marked it up here, and you can see the R1 level would be quite significant if we were to get up there. Decent price action around that point. Oh, Saif hasn't just. Here we go. There you have a look. The chart's changed there. Have a look at the R1. Yesterday's high in the mix there as well. Worth having a little focus on if we were to push on. But I think for the morning, probably best not to get too involved. One chart as well that we've mentioned a couple of times about the if there is going to be dollar weakness, might benefit a bit more, and as you know, its low of 2018 seems a bit further away than that of the pound and euros is the Aussie dollar. While I like to, you know, from a personal point of view, like to get into a trade when there's, say, two technical points, R1 and yesterday's high, you could say is that. I think, you know, not necessarily we're going to get up there, and if we were, it might well be because of a weak non-farm number. But I prefer the level just a bit higher up. The higher the 22nd. You've also got R2. You know, for me, yesterday's high a bit too. Well, it's already been tested, I think, with the 25th high there. So for me, Aussie dollar, I prefer from a bit higher up. If I was looking for that short, but really it would be a case of waiting for that data and then making a decision later on as well. Obviously, gold. We've mentioned a few times, and Saif did it again there, just how choppy it has been. Obviously worth having this trend line going on from the bottom there. Key level though, from a technical point of view, so it will be interesting to see where we finish this week, where you can see the lows from the beginning of May. We've come back and tested them once, twice, 3 times yesterday as well. So if that can keep getting squeezed in, maybe we get that push, and we look to stay above the 1300. But for now, overall direction for gold, I wouldn't really want to place a bet on that. Pound as well, recovering slightly from the low that we've had. Technically, you've got a bit of support around the S1 today, and then the R1 and yesterday's high as well. Would just be better to get on the mic, I think, just a bit before the release comes out, to perhaps focus on better levels where we trade. Going into that number at 1:30, I just don't think this morning's going to be the best time to be looking to trade. You know, very rarely in the morning leading up to non-farms is there a great opportunity. Equities still relatively mixed. I mean, look, you can see every time we look to go one direction, we come back and go back into the range for that there. S1, quite a good price action from yesterday, and obviously the high of the range that we're in also around today's R2. Obviously there'll be quite important levels for us to get through in the meantime. I think later when the volume comes in, and obviously post non-farm, you might see a break to the downside. If you were looking to go short, a break to the downside could be a half decent opportunity to have a look at there. I think if we were to push to a new high, R1 would be the obvious target, along with the previous low that we did break down through just before the cash open. Pivot on a shorter time period, you can see has acted quite well this morning as resistance, and then finally breaking through and coming back as an area of support. So that would be another one to focus on, perhaps more of a shorter term trade. But just to stress, I wouldn't really be expecting too much from these markets this morning. Oil as well, just coming up to key level of resistance actually as we speak. I have this marked up on my charts. You can see yesterday offered a good level to stop price going higher. The pivot also there today, so one to bear in mind. If we do get a push through, you might see a bit of an extension, albeit the volume for the day at the moment is going to be relatively low. Worth getting another trend line on that just in case you are to see this level hold up and get a break lower. So, you know, I think sit on the hands. Dollar index not doing too much. Stocks in Europe, let's have a look at the DAX. So you go actually coming to quite an interesting level. Was the previous lows of the afternoon of the 30th, low of yesterday morning. So quite a key level that we did come back and test initially already. So just keep an eye on that, I would say, as well for the Euro stocks, which just above where we're trading, you've got the R1, but probably more importantly yesterday and Wednesday's high for those levels. Quite a key area for Euro stocks to the upside. If we were to get a breakthrough there, I would expect similar resistance struggle around the low, the 28th that we did break through. So quite an important time for stocks in Europe. Wouldn't necessarily expect we're going to get a massive push through though, so interesting to see what happens around there. Obviously non-farm afternoon this morning, so everyone in-house, please do get your predictions into me. Pound in a cup. Having won the competition twice, you know, if anyone does want any advice, obviously just come to me, and I'll be more than happy to let you know. But if I don't speak to you guys throughout the day, hope you all have a great weekend and trading day.